Hey, Brian Mahone here. I'm a certified risk manager here at Engelham Bright Davies, and this fall I got invited to speak to the Pennsylvania Association of Community Health Centers on the topic of the Federal Tort Claims Act and gap liability and claims process, and also cyber liability and incident response best practices. So this recording will go through the presentation here. So without further ado, these are our learning objectives for the session. So two for each. So we'll jump in. Define how the Federal Tort Claims Act gap liability claim process works. And the FTCA is actually a federal legislation enacted in 1946 that provides legal means for compensating individuals who have suffered either personal injury, death, or some sort of property loss or damage caused by negligence or a wrongful act of an employee of the federal government. It's actually a solution put in place after a B-25 bomber from the U.S. Air Force crashed into the Empire State Building, killing 14 people. Eventually that law got extended to community health centers through amending Section 330 of the Public Health Services Act and extending the Federally Supported Health Centers Assistance Act in 1992. So essentially, covering employees of community health centers as if they were federal employees. I mean, they really are. They go through a deeming process and have to apply to become a federally qualified health center, as many of you know, and helps you because it eliminates or reduces premiums really spent on medical malpractice insurance. So what's interesting is the coverage is occurrence-based. It has no minimum or no maximum limit. However, punitive damages are not allowed. So I won't read through this slide because there's kind of a better chart that outlines this. But essentially, if a claimant wants to claim, they were wronged by a physician or a provider of your medical center, they have to go through the Department of Health and Human Services, the Office of General Counsel, and go through their law division, and they have a special claims and employment law branch. It's a pretty long process. Takes about 6 months and can either get kind of a denied or accepted. And eventually gets really defended by the Department of Justice. So here's a chart that kind of flows through that. I actually read through the whole Federal Tort Claims Act Health Center policy manual that outlines a lot of these things and kind of simplify them throughout this presentation. So what's important to note is there's an issue where you have premature or state lawsuits where these individuals don't really understand this process and they go to a state court or you get a scary letter in the mail. All you have to do, or really the recommended way to go about that is ask for a 60-day extension, call the U.S. Department of Health and Human Services, let them know immediately, or you can even email them and ask to speak to one of their attorneys to really get that flipped to the federal courts. So regardless, there's a ton of documentation you'll have to gather. Here's a list from the manual, which, reading through it kind of makes sense, right? They want 3 copies of the summons or complaint, your deeming letter or redeeming documentation, 330 applications and forms, a statement identifying which providers are involved, any evidence, payment, IRS forms, W-2 or 1099, the medical records of the plaintiff, any correspondence or communication, and then kind of a main contact and any details if you do have a gap policy. There is a statute of limitations. It's about 2 years. Important to note that if there is a claim that gets paid by the FTCA, it then gets reviewed by the Medical Claims Review Panel to identify if the standard of care was met, and then report that to a national practitioner data bank for kind of a black mark checking of individual providers. So say this whole system didn't exist, you had to deal 100% in the private medical malpractice arena. Um, this is kind of what it looks like out there as an FYI. So you can think of this as gap or just regular malpractice insurance. So Pennsylvania is a top five state. This is data from one of our carriers, MedPro. They write about 10% of all medical malpractice in Pennsylvania and nationally. My understanding is these kind of nuclear verdicts or large verdicts are a new phenomenon. Some venue laws changed where in the past these claims would go locally to wherever the plaintiff received care, but now as long as there's a financial transaction anywhere in the state, they can choose different venues. So a lot of them are going obviously to kind of Philadelphia and Pittsburgh, so they can potentially get more money out of their claim, even if the actual malpractice mainly occurred somewhere else. Um, so yeah, just showing Pennsylvania is worse than the country as a whole. And it's not really a frequency problem. It's more of a severity problem, which is interesting. There used to be about 20 claims per 100 physicians. Now it's down to almost five. But the uh, amount of court awarded verdicts over $10 million has gone up 400%, which is pretty crazy. And this was, I'm not going to play this, but this is an interview. I'm assuming everybody will get these slides with the CEO of another carrier, the doctors company that writes a good bit of Federal Tort Claims Act gap liability coverage. And one interesting thing I took away from the video was really that, um, obviously there's attorney advertising. You probably saw a million billboards in the way here on the turnpike or wherever. But this idea of social inflation, right? That attitude toward willingness to sue and the desensitization of the value of a dollar, right? We, as everyday people, kind of hear about lottery winners or professional athletes' contracts or even CEO pay or executive pay. So these dollar figures don't seem as outrageous to these jurors, really. Um, but also just laws have changed, rollback on tort reforms, increase in third party litigation funding, and an increase in class action lawsuits. They also have another really cool kind of mock trial video that can help kind of prepare for this type of situation. I think there was a stat out there that 1 in 10 physicians through their career will have to go to trial, which is concerning. Um, the doctor company also had a ton of kind of mini interviews as well with 7 different physicians about their experience with medical malpractice litigation while they regularly perform in-person kind of surviving litigation seminars. So onto our second objective here, identifying gap exposures, right? So we'll talk about what's covered, what's not covered, kind of break it into different categories. Really, the bulk of the coverage, again, if you're a W-2 employee, board member, executive officer, or qualified contractor, coverage is automatic. When it comes to the medical providers, right, we're wanting them mainly to be full-time in these specialties: primary care, family practice, internal medicine, pediatrics, obstetrics, or gynecology. Midwives are considered primary care. But the issue comes into play with kind of contracted or I'll say outsourced individuals who don't work full time, which is identified as 32 and a half hours per week. Um, so, oh yeah, part-time dentists are included as well. There are different common covered services to non-healthcare center patients that the Federal Tort Claims Act Health Center Policy Manual talks about, which again, these make sense: school-based or school-linked clinics, community fairs, immunization campaigns, migrant homeless camp outreach, hospital-related activities, or emergencies, right? Um, One thing to note is paying individual contractors. Um, they want that to be directly to individuals, not through some sort of sole proprietor LLC. What is not covered is unfortunately a lot more than what is covered. There's 3, 4 slides on this. So again, I won't read all of these. What we see a lot really is because of, I'll say, COVID. Many community health centers have started to offer more services around pharmacy, around behavioral health, infectious disease specialists, and not always, but sometimes may have overlooked or assumed or not done kind of timely due diligence on how these new services or exposures are picked up for medical malpractice outside of the Federal Tort Claims Act, right? Um, Other thing is training physicians, Good Samaritan coverage, moonlighting, um, teaching, residents in training. What's interesting is the Federal Tort Claims Act is medical malpractice only. It's not picking up general liability, cyber liability, workers' comp. Another overlooked gap here is sexual abuse or molestation coverage. Obviously, a lot of community health centers are offering services around pediatrics. Um, so that's a concern and not considered malpractice. It's considered alleged criminal activities a lot of the time. And then you have to be careful with your contracts, right? Which I know a lot of community health centers have some sort of either in-house or outsourced general counsel or legal service where any contractual contract with indemnification language, the Federal Tort Claims Act is not going to step in and do that automatically. You'd want to either remove that language from the contract or get a gap policy, which we'll talk about. Also, just logistics, right? So when you do have these contracted um, providers that are part-time, you can make them go get their own malpractice insurance and just show proof of that on a certificate, and you're good to go. Or you can add them into a gap policy and kind of cover that for them or on behalf of them, or just have some peace of mind there. So how do you evaluate your gap? Well, what's really nice is there's a 1-800 number if you have any questions. So I included that down at the bottom. Any covered entities, covered individuals, covered activities. The And again, this is taken right from the manual. But applying for covered coverage, even if you don't end up buying it, is a great way to determine your gap, right? So the things they ask for when you apply for gap liability. And again, this is just medical malpractice coverage for items that falls outside of the Federal Tort Claims Act government immunity, right? They want a copy of your HRSA deeming letter. They will make you fill out an insurance application, right? Which is a lot of the exposure basis or the rating basis is around the number of visits you have, both current and projected, deemed, non-deemed, current and estimated revenue, and how your services are broken out by different providers and specialties. And then really drilling in on that provider census data, names, specialties, number of hours worked, W-2 or 1099. Again, if a provider doesn't have their own medical malpractice, they might be asked to fill out an application to get included under the gap policy for your health center. So some examples I've personally worked on: health center starting a pharmacy, employing behavioral health or clinical psychologists, individuals, having a contracted infectious disease specialist. This one was interesting because yes, it's a covered activity working with a school, but and yes, the sports medicine physician was covered, but not necessarily under FTCA when they are advising a physical trainer located at a school. And then some health centers just want peace of mind, right? If God forbid there is a claim and the U.S. Department of Health denies it, they're paying out of pocket for legal defense. So that's exactly what this policy will pick up. And these policies, they're not inexpensive, but I won't say they're unobtainable. Might be looking at 15, 20,000, $30,000 for $1 million. Each occurrence, 3 million aggregate coverage. So again, occurrence is per event, and aggregate is the maximum throughout a policy year. And both deemed and undeemed activities can be covered. All right, moving into cyber world, we're kind of at our halfway point here on topics, right? Um, so what's going on? What exposures from a cyber perspective do health centers have? Who's doing this? Why are they doing it? Um, let's start with who. There's a misconception out there, right, that these hackers, bad actors, are some guy in a hoodie usually, and that's just not true. I mean, these are full-fledged businesses with help desks and call centers, and they take it very seriously, and they're very well funded. But there's kind of different types of, say, bad actors, threat actors. There's advanced persistent threat groups. They're the most advanced, kind of low and slow, long-term funded. It's thought that the Change Healthcare, the Optum United Healthcare cyber attack earlier this year was an advanced persistent threat group. I believe Russian backed. There's also just organized crime gangs that, proliferate malware and do spam phishing, and they're just out to make a quick buck. And finance and healthcare, again, huge targets for them. There's corporate, espionage, industrial spies. China's been known to really have a lot of hacking groups stealing U.S. Intellectual property. There's just, brute hackers, script kiddies. That's like your teenager with a gaming laptop and YouTube, just kind of out there having fun, trying to break things and hack people for notoriety. There's actual worm or code writers, black and white hat hackers, where both of them are really doing penetration testing and trying to force their way into systems, where white hat hackers, you typically know about it, and they don't have a malicious intent, where black hat hackers do have a malicious intent and do not have permission. Um, Hacktivists, kind of interesting. Typically, these are hacking groups. A really well-known one's called Anonymous, that you might have heard in the news, that they're politically motivated. They're not really, trying to steal your information to make money, but more want the notoriety for a cause. So again, most FQHCs are nonprofits, or really all of them. And public entities, governments, municipalities are often targets of hacktivists. So maybe, I don't know, they're against some sort of healthcare service you're offering and want to shut you down because they don't believe that that should be offered. Um, there's also insider threats, right? The disgruntled employee, the Edward Snowden, the I hate working here and I'm gonna steal everything on my way out, or I'm gonna maybe purposely get a job at your company and then take you down from the inside. So how are those different groups of hackers doing this? They do it a number of ways. Phishing and ransomware, probably the two most common, but there's also distributed denial of service attacks, where this is where they get a group of computers all to point at your server all at the same time, where maybe your server is used to seeing 100 computers a day. They're going to throw 10,000 at it, and it kind of breaks through. Also, funds transfer fraud, again, is really a big one. Employee says, "Oh, I need to change my direct deposit with the HR payroll person." They say, "Okay, sure, I'll go ahead and do that for you." And they didn't make them fill out a form. They didn't call and verify that that email was legit. They just go ahead and do it. And then all of a sudden, they don't get paid for 2 months and they're confused. Or vice versa. Controller gets an email from a CFO, "Hey, we need to pay this bill immediately." They don't call to verify, fill out a form, double check, and they wire money out the door. So some banks are getting better at offering tools to avoid this, whether you have to go in person for large transfers or large payments, or some sort of approval when it makes you log into the bank. There's ways to go about that. And then of course there's also insurance if those processes and banks can't help you. So again, why are these people doing this? A lot of times it's for money, and this is a really cool chart that just shows how personal health information can be monetized. It's not just like, oh yeah, we sold it once, but there's all sorts of different ways they can do it. They can, impersonate physicians. They can impersonate patients. They can, forge things. They can sell it to a data broker. They can hold it for ransom on the dark web. They can, commit credit card fraud. It's pretty eye-opening why healthcare data is really the most valuable. In terms of exposures, right? Every industry has their unique exposures. This is, what's going on from an exposure perspective, taken from one of our carriers, CFC, so what they call their cyber risk heat map. And I've spoken with and working with community health centers that have had breaches that have caused, weeks of downtime, hundreds of thousands in costs for HIPAA violations, lawsuits, data restoration, IT forensics. They've had years of patient records lost and employees' personal data. So that's why you're seeing really that red square under business interruption and system downtime. It says I know the font's a little small. It says a cyber event disrupts operations at your health center, resulting in canceled appointments, staff overtime, and rerouted services. So, if someone really needs healthcare, they're going to go somewhere else, right? And of course, the privacy piece of it. PHIs lost or stolen, leading to widespread notification, corrective action plans, and other regulatory expenses. The increased, let's say, legal landscape, privacy laws really increases the need for cyber insurance and taking cybersecurity seriously. So Pennsylvania currently does not have their own privacy law, but it's in cross committee. We do have a breach of personal information notification act. This has been used once against Uber. They lost 13,500 Pennsylvania Uber driver's licenses. And this eventually turned into kind of a nationwide class action lawsuit. But just the Pennsylvania piece, they were fined $1,000 per record for $13.5 million through the Attorney General. Reputational costs of a data breach, right? When these things happen, a lot of times there's a lot of work done by PR professionals to keep your name out of the news. Publicly traded companies don't have that luxury, but just the impact of that, right? I mean, 85% of people tell others about negative experiences. Half of consumers, broadly speaking, move to a competitor after news of an incident. There's loss of trust, and sometimes, I guess, due to the geographical nature of a lot of community health centers, maybe some of your population have no other choice, but those that do certainly will defect or try to move away from your organization. So how do you evaluate this? There's a few ways. Some expensive, some more inexpensive. So I wanted to share them all with you. One of the ways is if you could figure out how many records you have, PHI, PFI, PII, a ballpark range is fine. Maybe you can run a report from your EHR or have some sort of data inventory completed from an IT professional. Once you know that, there are a ton of these costs of a data breach studies. The Poneman Institute, IBM, Verizon, Net Diligence, they all have these claim studies that come out, and what they all say is the cost to rectify a record is between $100 and $300, right? So say it's, I don't know, 200, and then you multiply that out, right? So I have 10,000 records times 200. There's your cyber risk. There are also cyber claims databases, like one of the biggest cyber carriers in the world, insurance carrier called Chubb, has about 20 years of actual cyber claims data, and we'll actually run through a live example of that here shortly. And then the third way are there are a lot of tools. I'm sure, cybersecurity folks can follow some sort of NIST framework or um, like sys controls. But there are other tools that will actually kind of give you a score, almost like a credit score, security scorecard, BitSight, Corax, CyberCube, and they typically are using more predictive analytics. They will scan your URL, your email domain, and try to come up with kind of a measurement of if you're in good shape or bad shape. Some of them score, 0 to 1,000. Some of them score A, B, C, D, E. So we're going to create a fake community health center here. ABC, FQHC, or I hate compliance FQHC, whatever you guys want to call it today. Um, and we'll just make them kind of a combined, or actually, I think I made them a rural FQHC. Yeah, so we'll take that 11 million figure. Again, Capital Link is a nonprofit organization that does a lot of analytical reporting for FQHCs across the country. It helps with their operations, right? So we'll take that 11 million figure. We estimate maybe they have about 10,000 records at that level of revenue. And what Chubb's telling us is all the incidents they've seen throughout all industries here. You see a giant spike over COVID there at the beginning of 2019, kind of ending in 22, and we're kind of at this low point right now. I imagine that will shoot back up here, but yeah, healthcare is kind of known this is an issue for a long time. They've spent the money on cybersecurity, so that's why you're seeing less claims in healthcare there. But what they say is with that revenue, with these records, your cyber risk is about $3 million, and they break it down by um, the various items you'd have to spend post incident if you lost those 10,000 records, right? So investigating the incident, managing the crisis, potentially payment card industry fines like credit cards, um, HIPAA fines and penalties, ransomware, data restoration, business interruption. Most cyber insurance policyholders we're seeing have about a $1 million limit or below, so they're underinsured, where their retentions, which act like a deductible here, are typically in the 1 to 5,000 range. So you're seeing the retention here on the top, or the retention on the left. Uh, uh, yeah, the policy limit on the left and the retention on the right. And we just supplemented the Chubb data with Advisant's benchmarking data here in the bottom. And pricing, honestly, is all over the place, right? Depending on those limits. But most health centers, aren't spending more than $25,000. Most are below that frame. And again, if there is an incident, right, it's 72% of the time is coming externally outside of your network. No surprise there. It's most likely 38% of the time some sort of phishing, social engineering method, or just brute hacking or malware. So that's no surprise there. All right, so let's kind of start wrapping all of this up, defining how the cyber incident response process works. Well, it really starts with these guys, these cyber insurance carriers. If you have a robust insurance carrier with a good policy, you'll find they all come with a 1-800-365 incident response hotline. That hotline is manned by a data breach response coach who is a privacy attorney. And what they do is they act as the quarterback to spearhead and kick off all the various incident service providers. So the first thing they're going to do is work with forensics to figure out what happened, how the bad guys got in, what data did they take, was this cyber incident truly a data breach? Because a data breach is a legal term, right? So if they do determine it's a data breach, they will notify the impacted individuals through maybe Experian or Equifax or some sort of notification service provider. These policies also can pay fines and penalties They will pay business interruption, right? If you're a sitting duck because your EHR system isn't able to be accessed for 2 weeks, right? You're losing out on revenue. You're not able to see patients. These cyber policies can pay that lost downtime to continue to pay your net income plus continued operating expenses, right? Your overhead, your taxes, your insurance, the things you'd have to pay anyway. They also a lot of the times pay for ransomware negotiators, kind of ex FBI, military folks who might play along with these threat actors saying, oh, we're just going to restore from backups, or, oh, can you do 1 million instead of 2 million, and buy you time to restore, or if they figure out you're really SOL, then hopefully pay that ransomware out lower. So it's a pretty dynamic product. Hopefully you never have to use it. There are other carriers out there. You might have heard of some of these. Um, what's interesting is these kind of newer players to the space, we're seeing a lot of them do, I'll say, active monitoring or proactive underwriting, where they're using things like BitSight to scan your domain externally, your website externally, to identify some potential vulnerabilities, either pre-underwriting or throughout the policy term, which is interesting because they will actually alert you and say, "Hey, we see there's this open remote desktop portal open to the internet. That could be a door that a bad guy could open. Please close that. And if you don't close it by the time your policy renews, then we reserve the right to non-renew you or jack your rate up or whatever. But they're looking out for you, right? Uh, what's interesting, so here's a sampling of those post-incident service providers, right? So these are you probably recognize some of these names, but these are the firms that these cyber carriers have pre-negotiated rates with and have been pre-approved by the insurance carrier. It's important to note, if you have, a security vendor that you love or a privacy attorney you love, um, the time to negotiate them onto your panel is when you buy the policy, not come claim time, right? And some carriers will exclude coverage 100% for non-panel service providers. So if you panic and call the IT restoration guy down the road and spend a bunch of money and then say, "Oh yeah, insurance carrier, we had this breach, this incident. Here's our $30,000 bill," they might say, "Yeah, no, thank you." Um, Unfortunately, most policyholders are not taking advantage of some of the pre-incident services that these cyber carriers come with, right? Um, some carriers are more sophisticated than others. Some have even built their own MDR products that they're offering with cyber insurance. A lot of these are just little giveaways. Hey, spend an hour with our breach coach security person, or hey, here's a free employee security awareness training video, or here's a discount on this piece of software, this compliance tool. It's nice to know what these are, but unfortunately 90% of policyholders don't use them, right? So what can you do? Well, do not be afraid to call the insurance carrier. There's something we refer to as a notice of circumstance versus, hey, I'm filing a claim. It's, hey, our CEO left his laptop in an Uber, or hey, we had some weird traffic on our website, but we don't think there's a bad guy in our system. It's a, hey, insurance carrier, an incident happened. We don't think it's a data breach, but we wanted to let you know about it because we don't want to be penalized. Because a lot of the times there is language built in these policies that limit the amount of time that you can file a claim. So you can't just say, "Oh yeah, we got hacked 9 months ago. Can you help us out?" That's not typically how it works. It's usually like 30 to 60 days. Um, we did talk about getting panel providers approved. Do not destroy logs. Again, if you panic and call the IT guy down the road and he goes in there and starts deleting a bunch of stuff, there are logs of, what IP addresses and what traffic has happened on your network and when and where. That is how these forensic specialists do their job. It's a crime scene, right? you wouldn't see a bunch of yellow caution tape and chalk out on the road with a bunch of police lights, and then just start sweeping up the pavement in the middle of their investigation or right before you ask them to investigate. You do want to act fast. These things, unfortunately, they happen, at 2 a.m. on a Friday night, Memorial Day weekend. And you might have to make some phone calls in the middle of the night for sure. But speed is important. The faster you can kind of deploy forensics and engage a privacy attorney and get moving, usually the better the outcome. Um, Hopefully you have an incident response plan. If not, there's a lot of individuals that can certainly help you with that. There's free templates. You can, go all out on spending money on it. But when you have that plan, you at least know who's on your team. Who do you need to communicate with frequently? We find a lot of organizations that have some sort of larger data breach. They will actually set up a reoccurring, call, whether that's on the phone or maybe a virtual call every single hour or every 4 hours with their data breach response team to just stay up to date on what's going on. What do we need to do next? Who do we need to communicate with? Um, what's interesting is there's kind of a mystery of how these cyber insurance policies are rated. There's kind of five ways I tell everybody, right? What you do, right? Okay, I'm a community health center. That's my industry. Our revenue, how big are we? Are we, a rural 10 million revenue or an urban 30 million revenue or something? What kind of data and how much data you have. Every organization has, PII on their employees, and healthcare providers obviously have a ton of PHI. So how much? Have you had an issue? And if not, and obviously a no answer is better than a yes answer. But if it isn't a yes answer, it's not the end of the world. You just have to tell a story, write a narrative, right? Of what happened, when it happens, how the bad guys got in, what did you do to rectify the situation? Why are you in a better place now than you were before that incident? But the only one you can control is your IT controls. And I get this question all the time. Well, if I'm, Fort Knox and I have the best cybersecurity, can I get a discount on my cyber insurance? The answer is, of course, yes. So if all the parameters are the same, items 1 through 4, you have company A and company B, but company B has better IT controls, their swing in cyber insurance premiums could be upwards of 30%, maybe around 15. So always, again, I don't think there's a million IT people in the room, but I really like this graph as just kind of a traffic light of good, better, best, red, yellow, green of if you're an organization that's still struggling to implement MFA and good backups and an incident response plan and security training, like you're behind the ball. You're barely qualifying for cyber insurance these days. If you're pushing into the green here, you're looking at, an MDR monitoring solution with 24/7, eyes on glass, or a outsourced security operations center. That's where the industry is kind of pushing everybody to go, because a threat actor can get into your system, but they're going to kick them out very, very quickly. And, the $3 million issue is going to turn into a $30,000 issue. More information on that. So yeah, EDR is the software that's analyzes your endpoints. Endpoint is your phone, your laptop, your server, um, and its goal is to identify security breaches. Where the MDR part comes in is the managed part. So the EDR is the software, the computer, the technology. The M part is the humans, the monitoring physically. We call it eyes on glass. So if you were to build your own SOC, security operations center, it would cost roughly $1 million. So what these companies are doing, Huntress, SentinelOne, Sophos, CrowdStrike, are offering outsourced security operations centers, or MDR solutions, or the combining EDR with people, because cybersecurity people are very expensive. All the good ones are almost ex-military. There's a huge talent gap in that industry. Um, So if any of you are considering one of those, highly, highly recommend it. They're not all created equal. So do due diligence on that for sure. So tips for cyber insurance buyers, you want to work with insurance professionals that understand cybersecurity as much as they can, and work with IT professionals that understand cyber insurance as much as they can, right? They both have to stay in their lane, but certainly hand the baton off and collaborate and know some common terminology. You want to start early. Um, at least at our agency, we're starting to think and get notifications to renew policies 120 days in advance. I'll say that's kind of extreme. The norm is probably 60 to 90, but if you're only dealing with it, weeks out, 30 days out, sometimes, you know, it doesn't go as well. Appetites change, underwriting guidelines change, pricing changes, coverage changes. We'll talk about that. Again, take advantage of any pre-incident services your current policy already has. You might as well. You're paying for it. This is a huge one. Anybody who maybe CFO, CEO, whoever's in charge of IT, put the 365 24/7 through incident response hotline from your organization cyber insurance policy in your cell phone. Because again, you might not have your laptop. It might be 3 a.m. in the morning. Like you're going to need that lifeline, so to speak, more readily available than having to go in the office and actually, sift through an incident response plan physically. And then the last one, of course, invest in controls and ones that cyber underwriters care about, right? The application process, I'll admit it's not a fun one. I want to keep in mind that it's a risk management exercise. What they're trying to figure out is how are you mitigating risk? The more information you can give an underwriter, the better result you're going to get. You want to be thorough and descriptive as possible. If for whatever the application you're filling out is just a bunch of yes, no questions, pretend they're fill in the blank. Explain and describe any updates that have been performed or expected to be performed. Um, if your policy renews July 1st, and you have this huge project to deploy MFA across every, you know, organization's, your whole organization's endpoints or MDR or whatever, let the underwriter know that, right? That can be taken into account. Hey, we're investing in these things. They won't be done by the time our policy renews, but we wanted to let you know so you can, bring that to account and potentially get better coverage, better pricing, lower deductibles, higher limits, whatever it is. Um, yeah, I know a lot of IT folks will read a question and they'll say, we're 80% to a yes on this question, but I still have to answer it no. Right all over that application. That application actually becomes part of the policy, right? So you have to be careful. There have been, this claim denied was interesting. It was actually a manufacturer in the Midwest, and I think it was the CEO said, "Oh yeah, we have MFA." Well, it turns out he only had it on like one little piece of software. He didn't have it on, company network, employees' emails, privileged access, IT administrator access, and Travelers denied the claim. And it basically said you lied on the application. So you have to be careful about that. Should be a collaborative effort between insurance provider, agents, outsourced or in-house IT, and then as well as a controller or finance executive of some sort. Another thing you have to be careful with is that not all cyber insurance policies are created equal. There's no common terminology. There's no skeleton or ISO policy form that they are all building off of. So the core DNA of a cyber insurance policy does not exist between the 20, 30, 40 carriers there are out there. So some things that they get really funky with is the things that will actually happen, of course. If you have $1 million cyber insurance policy, you might have 0 or 100,000 or maybe 250,000 of that cyber crime, phishing, funds transfer fraud, computer fraud type of coverage. Same with ransomware extortion. You might have lower limits or co-insurance or a sub-limit. I see this all the time. Some nasty carve-backs baked into policy details. There's also this idea of neglected software, right? So if you're still operating on, Windows XP or there's some sort of known common vulnerability out there that your IT folks aren't patching in a timely manner, these cyber insurance policies will slowly diminish the amount of coverage you have. So if say, you don't patch for a year, your coverage could go down from, say 1 million to zero or something like that. Bricking hardware replacement, this betterment idea, right? There's this concept in the IT world that you have an incident that's so bad it bricks your computers, your endpoints, your phones, your laptops, where they're as useless as a brick. They're literally a hunk of junk. Um, so these cyber insurance policies will actually pay to replace hardware, servers, laptops, computers. Um, but insurance isn't supposed to put you back in the place you were before the bad thing happened. And with Moore's Law and IT rapidly changing and growing, like it's really, really difficult to get, a 5-year-old Windows Surface Pro computer. So they'll just give you, the 2024 model. But there's a cap. So a lot of cyber carriers will cap their betterment or hardware replacement coverage in trying not to put you in a better place than you were, right? So uh, best analogy is if you crash your Honda Civic, insurance company is going to give you a Honda Civic back, not a Ferrari. But in IT world, sometimes the Honda Civic isn't made anymore, so they have no choice but to give you maybe a nicer version of it. So, and then this has really been a big theme in 2024, this idea of contingent dependent key supplier coverage from a cyber insurance perspective, right? This is exactly what the Optum Change Healthcare attack was. It was, hey, there was a cyber incident at this clearinghouse that we rely on to do business, right? This was the same with the car dealership, the CDK car dealership software. Hey, there's a cyber incident over here at this software supplier that we use, and now we're suffering a financial loss because of their cyber incident. You have to be very careful. This coverage is very sublimited, where maybe you have a few $1 million policy and you only have $250,000 of this contingent business interruption coverage. Um, So we've got a few minutes left here. I put a few bonus learning things that just we see with our FQHCs of just other risks outside of malpractice and cyber. These ones would be very quick. This idea of non-qualified deferred compensation plans. So I met with a FQHC. They said, "Hey, Brian, we have these providers, and when they leave, we can't bill." And it causes a big issue because it might take us, months to hire a new provider, physician, and then months to get them set up and up and running and us to be able to bill through them. How can we keep employees staying here longer, providers staying here longer? Well, everybody knows it's a talent war out there. It's hard. You obviously you pay them well, you give them good benefits, retirement plans, 401ks. But there's this other idea that used to kind of be called in the 80s, golden handcuffs, where, hey, we've identified you as a key player in this organization. Because of that, you're eligible for this non-qualified deferred compensation plan, and you can structure it however you want. In 5 years, 10 years, 25 years, you get a lump sum of however much money. And then there's kind of a life insurance component to it, but kind of an interesting idea. It's obviously expensive to do, but something where maybe you can push your average tenure of a provider from 3, 4, 5 years to 10, 15, 20 years. The other one we see is a lot of spoilage insurance claims. A lot of health centers have a lot of vaccines on site, and yes, they're subject to proper refrigeration, and there's monitoring of temperatures, and maybe you even have backup generators. But a lot of times there's not alternative storage locations where hey, there's an issue, but there's nowhere to move them to, or maybe staff aren't trained properly. Um, this is a pitfall in regular insurance. This is not considered contents or business personal property. It's actually considered spoilage. So you just want to make sure you have enough in the event of an issue. Another thing that unfortunately is becoming more popular, we do active shooter preparedness training, and now there's even insurance products out there called deadly protection insurance, um, where the ramifications of one of these incidents can be paid for by insurance. So whether that's counseling services for victims, property damage of bullets going through windows or whatever. Obviously, a business interruption component is there. Maybe medical or funeral expenses, things like that. Um, what's slightly interesting about the insurance is it doesn't just have to be a firearm. It could be really any handheld instrument with the intention of causing bodily injury or death. And the last one here, bloodborne pathogen training and workers' compensation claims. We see a lot of FQHCs who, again, administering vaccines or to children or whoever, have these small, frequent needle stick injury claims over and over and over and over. And what can you do about that? Training, having a good work comp carrier, but also having claims advocacy to make sure that those claims are getting reported quickly, dealt with quickly, and just a good relationship between everybody. Thank you so much. Appreciate it.